AI Finance Daily, where artificial intelligence meets your money. Here's something worth your next 5 minutes. Oh, the regulatory risk that could wipe 40% off AI stocks overnight. Let's examine a regulatory scenario that could trigger a 40% drawdown in artificial intelligence stocks, not as a prediction, but as a critical risk pattern we need to understand. History shows us that transformative technologies often face regulatory inflection points. In 1911, Standard Oil controlled 91% of oil production and refining, until antitrust regulations split it into 34 separate companies. Today, we're watching a similar concentration of power, but in computational capacity rather than oil. The top 5 AI infrastructure companies now control approximately 85% of the high-performance computing capacity needed for large language model training. This creates what regulators call a bottleneck risk. When you look at the actual hardware layer, NVIDIA currently holds roughly 80% market share in AI accelerators. At the cloud service layer, just 3 companies, Microsoft, Google, and Amazon, control approximately 65% of global cloud AI capacity. The machine is working exactly as it should, and that's precisely what concerns regulatory authorities. The European Union's Digital Markets Act and the U.S. Federal Trade Commission's ongoing AI infrastructure investigation both point to the same conclusion. Regulators see this concentration as fundamentally unstable. Here's the mechanical risk scenario. A coordinated regulatory action, similar to the EU's GDPR but focused on AI compute, could force these companies to, first, divest or separate their AI infrastructure divisions. Second, license their technology to competitors at regulated rates. Third, submit to strict oversight of their AI development processes. Looking at this through the lens of historical parallels, when AT&T was broken up in 1984, its stock lost approximately 43% of its value over the following year. The key difference today is the interconnected nature of AI stocks. A regulatory action against one major player would likely trigger a sector-wide revaluation. But here's what makes this scenario particularly concerning. The market isn't pricing in this risk. Current valuations of leading AI companies suggest investors are focused on the growth narrative while potentially underweighting regulatory risk. As of this recording, the top 5 AI infrastructure companies trade at an average forward PE ratio roughly double the S&P 500 average. So why do sophisticated investors still hold these positions? Because they're looking at the other side of the equation. Global AI computation demand is growing at approximately 50% annually. Even in a regulated environment, these companies would still control critical infrastructure in a rapidly expanding market. For individual investors, there are 2 potential ways to address this risk. First, consider geographic diversification within AI exposure, including companies in jurisdictions with different regulatory approaches. Second, examine your portfolio's concentration not just in individual AI stocks, but in the broader AI infrastructure stack. Many investors who think they're diversified actually have multiple positions that would be affected by the same regulatory action. Let's be very clear about the mechanics here. This isn't about whether AI regulation is coming. It's already here. The question is whether it will follow the gradual path we saw with internet companies, or the more dramatic interventionist approach we saw with telecommunications and energy monopolies. This analysis draws from publicly available regulatory filings and historical market data. But markets are complex systems, and no scenario is certain. The key is understanding the risk pattern, so you can make informed decisions about your own exposure. Remember, this is an educational discussion about market mechanics, not a prediction or investment recommendation. Always conduct your own research and consider consulting with financial professionals about your specific situation. This has been AI Finance Daily. Stay sharp. And if you want to keep thinking clearly about AI and your finances, follow the channel. We publish regularly, and every episode is built to give you an edge.